Brad Williams, Frugal Finance. What is a family limited partnership? A family limited partnership is a business structure in which family members come together to invest in a venture or business. In this agreement, family members purchase shares in the business and profits are distributed according to the shares owned as specified in the partnership agreement. Key points to know: ownership structure. An FLP typically involves multiple family members pooling resources to invest in a business or holding company. Partners, FLPs, have two types of partners: general partners and limited partners. General partners manage the business, while limited partners provide capital and receive a portion of the profits. Wealth preservation. Many families use FLPs to protect and transfer wealth across generations, leveraging tax benefits like gifts and estate tax exemptions. Risks. If the business underperforms or fails, members risk losing their investment or even facing debt. The structure of an FLP. An FLP consists of two types of partners. General partners. These partners usually own the majority of the business and are responsible for day-to-day operations. They manage the finances, transactions, and decision-making for the venture. They may also receive a fee for their management role as laid out in the partnership agreement. Limited partners. Limited partners contribute capital to the business by purchasing shares, but are not involved in its management. They typically receive dividends, interest, or a share of the profits from the venture. Example of how an FLP works: consider a family that wants to invest in a luxury apartment development project. The total cost of the project is $1 million, with $500,000 required up front. The family members decide to establish an FLP selling 5,000 shares at $100 each to raise the needed capital. The family structure could look like this. The general partner, the primary decision maker, contributes $50,000 for 500 shares. Other family members buy the remaining shares, raising the full $500,000. With the FLP in place, the business can secure a mortgage for the additional $500,000 and proceed with the project. As the project generates income from rent, profits and dividends are distributed to the partners according to their ownership stakes. Advantages of family limited partnerships: tax benefit. FLPs offer substantial benefits when it comes to estate and gift taxes, which can help preserve and pass on wealth across generations. Gift tax exclusion. Each year, individuals can gift FLP interest to family members without incurring gift taxes up to a certain limit. For example, in 2023, the exclusion amount was $34,000 per married couple, allowing families to transfer substantial amounts of wealth tax-free. Estate tax advantages. Assets held in an FLP are generally excluded from the general partner's estate for tax purposes. As a result, the future returns generated by the business are not subject to estate taxes, preserving wealth for future generations. Additionally, the partnership agreement can impose conditions to ensure that gifted shares are not misused, such as placing restrictions on transferring or selling shares until beneficiaries reach a certain age. Drawback of family limited partnerships. Although FLPs can be beneficial, there are several challenges to consider. High setup and maintenance costs. Establishing and maintaining an FLP can be costly. Professional fees for tax specialists, estate planners, and attorneys are often necessary to ensure the FLP complies with legal and tax requirements. Liabilities and risks. Since an FLP is a business structure, it can expose partners to liabilities if the business fails or is mismanaged. The general partners are particularly vulnerable to legal and financial risks. Difficulties in transferring shares to minors. FLPs can present challenges when it comes to transferring ownership interest to minor beneficiaries. Special legal mechanisms such as Uniform Transfer to Minors Act account may be required to manage these transfers. FLP, a wealth building tool. A family limited partnership allows families to pool resources to invest in various ventures, like real estate, with the potentials for long-term financial growth. The structures not only enables tax-free gifting of business interests, but also provide an opportunity to pass wealth along to future generations. While it can be an effective tool for building and preserving wealth, creating an FLP involves considerable financial and legal complexities. Therefore, families considering this approach should work closely with tax professionals and attorneys to ensure compliance with tax laws and the long-term success of the partnership. Bottom line: family limited partnerships are an appealing option for families looking to invest in business together while maximizing tax benefits and preserving wealth. By structuring the business with general limited partnerships, FLPs offer flexibility in management and profit distributions. However, the complexities and potential risks involved, such as setup costs and exposure to liabilities, should be carefully considered before forming an FLP. If you have any questions or expertise in the area of family limited partnerships, comment. Brad Williams, Frugal Finance. Thanks for watching. Hope that helps. See you soon.